So, thank you for coming to my presentation. It's the small short. Not the big short, though. We are working on movie rights at the moment. But this is a small short. Unlike the big short that everyone knows about, which was a big systemic problem, this is a smaller story involving an individual equity and the people who run it. And before I get into the story a little bit, I'll tell you a little bit about myself. My name is Keith Dalrymple of Dalrymple Finance. I work with a partner who may be in the room here today. There she is in the front row. We are a research boutique that look for non-correlated investments, and we have a special expertise in short selling. And not to insult anyone's intelligence, but as this is not an investment conference, I'll just say with short selling, the goal is to make money from the decline in equity prices. So we do the opposite of what normal people do, in a sense. And to give you an idea of what's going on here, because a lot of the audience is lawyers, accountants, investigators, people who have other interests in companies, public and otherwise, I thought it would be interesting to basically present our story as a kind of consumer of a company in a way, as an investor. And unlike the way many people work, not under the guise of a big company in private, but out in public. So the larger story arc here is us having a short position in a company, going public with the findings, and then the real story starts actually with the fallout, which, as it turns out, is still happening today. So it's a story in several parts, and this is the early encounter. So first, as I get into that, let's talk a little bit about how we might identify a short opportunity. And to drastically simplify things, let's think about it in the terms of 3 F's: fraud, fad, and failures. If you have any of those things, the likelihood of the stock price declining over time tends to be great. So in essence, that's what we look for. With Gerova in particular, there was a variation on that theme, let's say. And let's say the first thing was classification. Gerova came into being not as a company going public like Microsoft, but as a special purpose acquisition company, or a SPAC. For those of you who don't know what that is, that's a company that goes public to raise money in order to acquire a company. So it's a stock in search of a company. Most of the time it will be backed by a private equity firm or an individual investor who's very knowledgeable about a particular area. Sometimes, as in this case, it is not. The second thing, the actors. This is something that we would look at. In other words, who are the management and the people involved and the sponsors of this particular company? And it's really important in fraud. As you see here, that's Kenneth Lay from Enron, Dennis Kozlowski from Tyco, if you recall the $6,000 shower curtains, that's him. And the dapper gentleman on the right is the mastermind behind Gerova, Jason Glanis. Everything in fraud comes down to the people. And lastly is the assets. And there are some people in this room who have been working on these assets for a great deal of time and a lot longer than we had worked on them. But the assets that Gerova was acquiring as it was trying to become public as a SPAC were a series of insurance companies on the one side and hedge fund assets on the other. It's a kind of, let's say, a modified Warren Buffett model with less skilled practitioners. And my partner here knew the assets prior to the acquisition and had an opinion that they weren't so great. And we concluded that they were not great as hedge funds, and they certainly wouldn't be good in a public vehicle either. Nothing would change that. And one of the things I can show you here is what we found in our early due diligence here in the early period of time. It's an article from the Columbus Dispatch talking about how some of the assets that they were to acquire, one of the firms was involved in a house flipping scandal in Columbus, Ohio. The company Stillwater was alleged to be a victim here, not a perpetrator. But one of the things it does say is that their housing was amongst the most blighted in Columbus. These were the assets Gerova was acquiring, blighted housing, urban developments in Columbus, Ohio. So we thought that it was unlikely that they would be particularly valuable. So here we have a SPAC, which a key aspect of, there are two key aspects of SPACs, or several actually, from our perspective. One I mentioned to you where they raise money in search of an acquisition. Two is that the shareholders get to vote. And they can vote to, if they vote yes, they keep the shares and continue with the acquisition. If they vote no, they can tender their shares and get their pro rata share of the cash that was raised in the IPO back, which will come into play later. And the last thing about SPACs is that, for whatever reason, they have a spectacular record of failure. So you, as a short seller, you might not even need to do much research on a SPAC at this particular time in 2009, 2010, because most of them declined in value significantly, irrespective of who was running it and what they were doing. And the last thing we have, dubious actors. I say dubious because in these early stages, when we were doing our initial due diligence, it was not in a particularly in-depth exercise. We read documents, we formed our opinions, but we didn't spend months researching at this point. That comes later. And we had questionable assets. So as the shareholders prepared to vote on the acquisition, we take a short position in the vote, and the voting information comes out, and the holders vote no. But as companies did at the time, they bought out the no votes with a particular maneuver, which we don't need to get into. So this essentially allows them to go public at any cost. And they make their acquisitions of the insurance company and the assets with restricted shares. So in essence, what you have is a fairly large public company with no public shares that trade. Over 80% of the shares were not tradable, tiny public float, so which is very easy to control. And lastly, the company had no capital. I think all in all, it raised $115 million after the no votes. We calculated that maybe there were several $5 million left over, something like that, which all went out the door in fees to various people. So let's emphasize that last part. This is a public company with no money and with assets that consist of blighted housing in Columbus, Ohio, and various things. So we thought that this would decline in value. We took a short position, and lo and behold, there it is. This represents the first several months of trading of Gerova as an acquisition company. So the acquisition took place right at near the beginning in January of 2010 and immediately proceeded to decline. And then it stabilized for a period of time. So as you can imagine, during that time, we considered ourselves pretty smart. We made money. We're nodding to ourselves gravely and patting ourselves on the back. But then some funny things start to happen. It stabilizes. We still think that it's not a good company. But then after a certain period of time, it stops stabilizing and it starts going up. And it goes up more. And then it goes up a lot. And we become re-engaged in the company. We take new short positions. And then at the end of the day, this happens. And if you're a short seller, and we didn't sell the stock short this low, and lose money all the way up to the top. But if you took a short position, anywhere on that curve, you're losing money. And so the question comes out, how could a company that you think, well may be a fraud, why would it go up 2 to 3 times in value? And there are a couple of interesting factors of why that could happen. Come on in, take a seat. The first one, indicated here, this is a June press release from Gerova about being included in the Russell 3000. Without getting into a lot of detail, the Russell 3000 is composed of companies of a certain size. So every year in the springtime, some companies fall in value and they're kicked out. Other companies rise in value and get included. And why is this important? This is important for a couple of reasons. One, because there are smart investors out there who do this calculation before it's announced. And so they're buying it in May in anticipation of a June event. That's one factor. And the second factor is when you have a company like Gerova that's, let's say technically it's a $3 billion market capitalization company, but in reality only 100 million in shares trade. When a company is included in an index, that means that there are certain buyers of that stock, and they would be large pension funds that have index programs, index funds, ETFs, and mutual funds that all benchmark to it. They're going to buy the stock. They're not expressing an opinion about management or the business or anything. If it's in the index, they buy the stock. And when you have a stock with no float that needs to be bought by a lot of very large investors, that's what happens. And as you could also imagine, if this was a dubious company run by fraudsters, who do you think was there to sell them their shares at the inflated value? That's right, the management of the company themselves. So they use this run-up in the stock to make, I think, a lot of money. And I didn't know this at the time. This is hindsight of 2020, putting together the Russell, but if management actually intended that, came out and intended for this to be part of the scheme, I have to hand it to them. It's really clever, in a kind of Lord Voldemort sort of way, but clever nonetheless. So another aspect that sort of aided and bedded this situation, where you have a company that essentially did a merger in January, and here we are, we think it's a fraud. Here we are in the summer, after a big run-up, somewhat of a decline and a stabilization, but in the summer of 2010, you're talking about 6, 8 months of a company you think is a fraud. You might say, why didn't other people catch on? And this is where the offshore comes in. And really, Gerova existed at the intersection of onshore reporting for offshore companies. And as everyone probably knows, U.S. domestic companies have to report quarterly numbers 3 times a year on Form 10Q. And once a year, they put out audited statements in a Form 10K, which is 90 days after the close of the year, March 31st for most companies. Foreign companies that trade on U.S. exchanges file quarterly numbers in accordance with their home domicile, which apparently in the case of Bermuda, which was Gerova's domicile, was never, because they never filed any quarterlies. And the annual report, which is the Form 20-F, is due 6 months after the end of the year. So if we're in 2010, as we ended 2009, their 20-F was due June 30th, 2010. And for investors, that's a great deal of time between things happening. And to illustrate, we can take a look at this chart. So as it came out as a SPAC and it held all money, cash, and trust, in 2009 it filed a 20-F with the SEC, but there's nothing to look at. It's $110 million in cash in trust, which management can't touch. The same in October of 2009. Same kind of financial statements, everything's in trust. The transformative merger between all these entities takes place in January 2010. The only financial information we have is, a pile of you-know-what in a proxy statement that is largely useless. And so we go through this whole period, and the next 20-F of audited statements aren't due until 18 months later, in June 2011, which is a hell of a long time in investment terms. So as we sat there in the summer of 2010 after losing money on this trade, that's where we were, right in the middle of a dead zone. Zero information. And that is what happened to the stock subsequently. So if we run back here, that's where the big run-up was. And it subsequently went down. So we recouped losses, made money at that time. The stock stabilized. But by the end of 2010, it was running up again for no real apparent reason, although they announced potentially more mergers and acquisitions. But remember, this is a public company, out for almost a year, never have filed financial statements. 0, not 1, which is, I find really astounding. And what's also astounding is that despite the fact that it looks like the stock has really been decimated there, that still represents over $1 billion of market value for a company that doesn't file financial statements, that owns blighted housing in Columbus, Ohio, and some other dubious hedge fund assets. To our mind, it was, $1 billion still seemed probably $900 million too much. So, and we were plagued by this question, are we right about this thing? Perhaps we weren't. So at that point, as many investors know, you don't always do all your work until you start losing money. So this is what we did. We really rolled up our sleeves on this one to find out what exactly is going to happen here. What we did was we expanded our scope. Initially, we would look at the proxy filing, which was the only thing. We expanded the scope to do deeper history on individuals involved, other companies associated with management, and the history of the assets itself. All of these things we tried to do, we went through public documentation. And this is not an extensive list of our findings, but it's a summary of our findings. And I think that it's a good representation of things that we found. Okay, 1, the actors involved. This is an article that, it's a clip, I'm sorry, that it's not quite readable, at least not with me without my glasses on. Porn's New King. Jason Glanis, who was involved in Gerova, had a porn-related business that resulted in a number of class action lawsuits. This article in the Forbes led us to this article in Forbes, which is about Jason and his father. His father, please take a seat. You're welcome. His father, at one point, received the longest white-collar sentence ever handed down to a white-collar criminal. And in this article, Forbes alleged that the father was actually running Jason's business from prison. Okay. This is an SEC ban from Jason he was banned from being a director of a public company for 5 years after neither admitting nor denying accounting fraud at Penthouse. And then lastly, at the end of 2010, a gentleman by the name of Matthew Sullick, who was the former CEO of Red Hat Software, sued a gentleman by the name of James Tagliaferri, who was on the board of Gerova, alleging that he stole $60 million from him. And our conclusion from doing some work on the individuals involved is that it's unlikely that this cast of characters was going to do things that benefited the public shareholders. Let's leave it at that. Second, related party deals, which were always a great part of short research. And I'll go through this with you. There's a company called Amalthus, which was purchased by Gerova, and there were a couple transactions involved with it. It's transaction 1. Amalthus was once owned by a company called Natprov. Natprov sold Amalthus to a company called Rinion, which was public at the time, for $36 million in cash. This was pre-Gerova in 2009. Now, the president of Gerova, Gary Hurst, was a shareholder of Natprov and a board member of Rinion. And Rinion, of course, didn't have any money to buy this great company. So it raised $36 million from private equity funds run by Gary Hurst. So there he is on all sides of this transaction. He's the financier, he's the buyer, and importantly, he's the seller. So at the end of the day, the cash goes into his pocket, out of his client's pocket. That's a red flag. Transaction 2 with Amalthus. Public company Rinion sells it to Gerova for 1 year later, in 2010, for $50 to $80 million worth of stock. So here you have this asset increasing in value at astounding rates, apparently. And of course, Gary Hurst was the president of Gerova, and the CFO of Gerova was also the CFO of Rinion. So this is clearly self-dealing. Lastly, and this is a very important point, this, I think, was the real smoking gun, which was discovered by my partner here, which is an audit from PricewaterhouseCoopers of a fund of funds that had investments in Stillwater assets. And this was critical because we maintained in our publication that the assets were worth a lot less than they had presented. And we suspected it at this time. And PwC came out with a disclaimer of their opinion saying that there was not evidence to support $136 million in valuation, that there were tax issues. They said that they had receivables due of $20 million that were dubious, and they didn't think that they could pay their leverage provider. And are there any auditors, people from the audit business in here? Unfortunately not. Okay. I was hoping there would be, because we've looked at a lot of audits, and you don't, yeah? Someone, yes?
I read a lot of audits, but you don't really see that.
Yeah, exactly. This is it. This is, I mean.
We often have the two retired auditors.
I see. So how frequently do you issue opinions like this? Very, almost never. Yeah.
That's what the data is. That audit.
I don't have the date up here. I'm happy to, I can send it to you.
They're smarter and they fire the auditor.
But this is 3 layers down.
Yeah, this is,
You can't see it from the public company.
see, this is not available at the public company level. You know, she had done research at the asset level. So I don't know exactly why it was public, right? Okay, so it was quasi-public,
Well,
right?
somebody has made a mistake.
Someone posted it on the internet somewhere. You know, it was not an SEC filing or anything like that. It was an error on someone's part. So this, in our estimation, was a real smoking gun that the assets were poor. So we no longer had any lingering self-doubts about what was going on. We'd found ample evidence of self-dealing, a history of legal problems and allegations of fraud, and a confirmation from an auditor of what people here know is very rare and disclaimer of opinions. So then the question is, in part 3, what to do about it? What's next? And the what's next for us was, well, let's bring the information public. I think we're considering 2 options for this. One was publishing it on Seeking Alpha, but the issue there is you publish it, so what, who's going to read it? And then there's also a website widely followed in financial circles called Zero Hedge. So on January 9th, 2011, after being involved with Gerova for a year and change, this was a Sunday, I sent a draft report to Zero Hedge and said, hey, we have this company, we think it's a fraud. Would you take a look at the draft report? Would you be interested in it? He got back and he said, yeah, send me a clean copy when you're ready. I'd be happy to post it. And so the next morning, Monday morning, that's what we did. And this is what came out. Allegations of shell game fraud involving Gerova Financial. He has a bit of a skeptical bent, and that's expressed in his write-up of our work. But he did provide a reasonable summary of what we did. And so at that point, it was out there. And we more or less waited. There was some behind-the-scenes work. I'd sent our report and our findings to the SEC, contrary to what the FBI said. No one ever contacted me. I also sent it to the New York Stock Exchange. And in addition to that, I sent it to a raft of journalists, none of whom contacted me at that particular time. And so it was out there in the marketplace, and we waited. And that's what happened. That represents the first week of trading after our publication. What happened actually was nothing. 0. I think at the end of the first week, the stock closed down 2%, somewhere in that range. And quite frankly, we'd done a lot of work, and we thought we had that company dead to rights, and it should be, maybe it was a $1 or $2 stock, but at the time we published, it was $29. This has a different price because it's split adjusted, and there was a reverse split after our report came out. But it was about $29 at the time, and nothing happened. But as the saying goes, be careful what you wish for, because it changed on Monday morning, on the 18th, a week after. Press release comes out. Maybe some of you investigators can relate to that, where Gerova announced that they've hired Kroll to investigate us for stock manipulation, which, you know, we're a couple small practitioners managing several $1 million for some family offices. You know, I'm not Bill Ackman, right? And it's a little bit of a scary thing for that to happen. But if posting about a stock that you think is a fraud on a financial website is not gaining people's attention, that certainly does. Because after this came out, the media became interested very fast, and then things started to happen fast and furious. The first of which, Financial Times came out. There was a British element to this, and there was an article in the Financial Times about it. The following day, DealBook and the New York Times wrote about it. And let me tell you, one of the things about these two articles that hurt a little bit is that they wrote about it in their own sort of fair way, but they were very skeptical regarding us, right? And which I found astounding, because I think we basically put out absolute proof that this company was a fraud, and certainly the people involved had dicey histories, but yet they were skeptical towards us, which at the time I found peculiar, although I no longer do. Then the real problems start. At the end of January 2010, Jason Galanis, the head, sues us. Following that, let's dwell on, I apologize for that. Okay, let's dwell on this first lawsuit for a second. So they sued us, Dalrymple Finance, myself, and my partner, in conjunction with Matthew Solik, the former CEO of Red Hat Software, whom we'd never met, and a guy by the name of Scott Hinz, who apparently was a former employee of the company. And the suit basically alleged that we all colluded together to damage Gerova's business and drive down the price of the stock to profit. Which was astounding, because none of us had ever met one another or communicated in any kind of way. So it was really news. And Matthew Solik, who had a very, very aggressive law firm and a significant budget, I must say, his law firm put out a press release refuting the allegations in the suit. But we were smaller individuals. We sort of held tight. At this point, this is the end of January, 3 weeks after the release of our report. We have one more media piece that came out, which was in the Wall Street Journal, written by a fine journalist by the name of Jean Eaglesham. This was interesting for two reasons. One, I think Jean Eaglesham actually read all the stuff and came to her own conclusions. And two, she actually did her own homework. She found her own sources and found some information, and that basically corroborated our position with information that we did not have. And she published it. As such, it was, from our perspective, a much better article. A week after that, basically all the management resigned. So let's do a little recap, because things happened fast and furious. First week, nothing happened. It was really boring until Kroll got involved, allegedly. And I say alleged because we never heard from them. The company said that the report would be made public after it was done. Never had it. I don't know if they were ever hired. Maybe they lied about that. Not sure. Third week, lawsuit filed. Fourth week, management resigned. As it turns out, hiring Kroll to investigate small-time research practitioners is not a sign that you're innocent. And that's what happened. So here you see a little timeline. We have the report that came out, Kroll announcement, stock down, management resignation, down more, and finally it more or less just collapsed. And New York Stock Exchange halted trading at 528. in February of 2011. And the trading was halted for several months as the lawsuit was ongoing. It opened up in April at $1, delisted on the pink sheets, and was headed fast for zero. So you look at that, and the really good thing, actually, is not on here, which is in April of that time, the lawsuit was voluntarily dismissed by Jason Galanis against us, so we were free. Although it would continue in a different guise because of Matthew Sulzik's, he was doing a complex legal maneuver. So this would come into play later, but from our perspective, the suit was gone, and it was over. And the ultimate proof of victory, at least in our business, is the stock's going to zero. And stocks do not go to zero just because Keith Dalrymple says they're worthless. If they go to zero, they are worthless. So we think that we have won, and we move on with our lives. But then, as it turns out, it wasn't quite over. Why not? There are other factors involved. One, people hold grudges. Okay, just because you beat them and the world knows doesn't mean that they're going to go away. Two, the truth is helpful, but quite frankly, it ain't everything. All right? In the end, it's good to have it, but that's not it. And so this is lawsuit number 2. Moving on with our lives, but in December of 2011, we get sued again, this time by a different lawyer in California. And this lawyer really liked press releases, so he put a press release out here, and what I've highlighted here is that he says that he sued us and Scott Hinz, but he left out Matthew Sulzik, the guy with the really big legal budget. And that we had done a short and distort reverse pump and dump, and we're the cause for them losing $800 million in market capitalization. Okay, so that came out in conjunction with the suit, another sort of frightening episode there. A month later, he puts out another press release, and this one is a...
Ladies and gentlemen, we have completed our testing of the alarm system. Thank you for your understanding towards life safety. Thank you again, and have a nice day.
Okay. In this press release, the lawyer talks about how Scott Hinz, one of the people who had been sued, was rebuked by a judge in another case. Mike, come on in. So at the end of, here we see at the end of January 2012, he puts out a press release about Scott Hinz, who apparently was rebuked by a judge in another case unrelated to us. But he did manage to relate it to us by saying that he talks about the lawsuit, in that the lawsuit alleges that that we joined together with this Hinz character whom we've never encountered in our lives, and Bulgaria-based short sellers to damage the company, which was really pretty astounding. But then the next piece, I think, is really, this is the real fascinating piece. So there you had the lawsuit and the press release at the end of December. At the end of January, you had this press release about the lawsuit and associating us with apparently a known criminal. But in between those two periods, you had a ruling in the Boston case, because the other defendant, Matthew Sulzik, was pursuing Galanis for fees and other things relative to a Rule 11, which, quite frankly, I don't know a lot about. But whatever Rule 11 is, and the whole dispute that we were not involved in, it did require a judge to look at it. And a judge looked at it and did come to some sort of decision. And the decision is that the allegations are not factually supported. And he didn't say that the evidence was weak. He said counsel did not come forward with any evidence. That's any at all. And because of that, he actually rebuked the law firm, and they were penalized for for breach of duty for not researching their suit. And thirdly, he says that the lawsuit was actually concluded that the lawsuit was filed for improper purpose. It was frivolous. And he said it was filed actually to extort money from Matthew Sulzik. So we were apparently just, a sideshow to this whole thing, unbeknownst to us. So, but the important thing here, if we think about what happened to us in the timeline here, is mid-December, lawyer number 2 files a lawsuit against us and issues a press release talking about how we're manipulating the market. At the end of December, the judge writes his ruling saying that his client's case, and the San Francisco case was just a repurposed Boston case, saying that it was absolutely and utterly fake. But that did not stop him from putting out more press releases accusing us. So while the first law firm was sanctioned by the judge, I was not happy about it at the time, but I have to say the firm, someone dangled a retainer, they didn't do their homework and they took it, mistakes were made, right? But they obviously dumped the client because they did not go for it. But the second lawyer, in my opinion, when you have a judge's ruling on your client's allegations saying that he made everything up, that's serious business, and that, in my opinion, turns him into a bad actor. In fact, as I was prepping for this talk, I went to his website to look at it because his website used to be plastered with his cases and press releases about us, which was disturbing to see. But now it's plastered with press releases about him being nominated to be a super lawyer, which is, I guess, something good in the law firm, and also cases that he's representing Native Americans and commercial fishermen. So apparently when he's not representing organized criminals, he's working for the indigent, which is good. But the second lawsuit that he filed in San Francisco was a bad choice of venue. Some of you might know that in California there are very strong SLAPP laws, which is strategic law against public participation. In essence, that is, it's a First Amendment issue, and that makes it very easy and relatively cheap to defend if it's a SLAPP case. So when we responded with a SLAPP defense, it can also make it costly for the plaintiff. So when we responded with a SLAPP defense, they immediately dismissed and filed a new one in New York, which has very weak SLAPP laws, almost none. The New York lawsuit number 3, filed in March of 2012, ended up dragging on for 2 years. There were 2 appearances. Unfortunately, the first appearance I did not attend. That was just lawyers in front of the judge. The judge, in my estimation, made a grave error by thinking that jurisdiction was a really interesting issue that should be investigated deeply. That required appointing a special investigator, which led to appearance number 2, where I sat with the judge and my lawyer and the lawyer for counsel from the other side, and we discussed not only jurisdictional issues. In fact, the judge, the special referee, who's a retired judge, he was really interested and fascinated by the Gerova case. So even when the opposing lawyer tried to make it clear that this is not what we're discussing, this is jurisdiction, the judge does not need to know about Gerova and the fact that this is not the first or the second but the third lawsuit, he overruled the counsel's objection and was very interested to hear anyway. So that ended up, thankfully for us, in February of 2014, that was dismissed. And we sort of, again, lawsuit free, we moved on with our lives and continued. But there's a hangover from all this. And one of the things is the Google effect. So as you can imagine, with personal relationships, professional relationships, looking for employment, the first thing anyone does is Google you when they meet you. And all they see is Stuart Gross's press releases about us manipulating stocks and committing fraud, which of course was completely false. But as it turns out, people don't really make up their own minds. They see what's on Google and it becomes fact. So there's kind of clouds hanging over us personally and professionally. And by this time, and even after the cases are dismissed, this is 4 years. And it's troubling, quite frankly. But then we get to part 5, vindication. In 2015, in the fall of 2015, I get an email from a friend and a client, which is this. And this is a press release from the FBI indicting 7 members of the company on criminal charges. And this, which is the SEC indicting them all on stock fraud, which at the end of the day resulted in that, which is another article by Jean Eaglesham, bringing together the whole saga to a close. And so that really brought vindication. And there are some lessons to be learned here in the saga over the 5 years that some of them are industry specific, some of them may be relevant to others, but dual standards in industry outsiders. In other words, if you're going to recommend an investment, buy Microsoft at 23, it's going to go to 34. And Microsoft doesn't go to 34, but goes to 3. No one cares. But if you recommend a short investment, you have to be right. Not only about the direction and what happens, you have to be right about every single little detail. Because even when you are right, you can still get in trouble. And that dual standard is very peculiar. Something else that I learned is that when you're involved a lot on the short side, people don't really like you. To put it simply, everyone in the industry supports short selling sort of in practice as a necessary part of a free market, so long as it's not public and not about a company that they own or like or have been an investment banker for or a lawyer for. That's one thought. Flawed legal system. There's apparently very little disincentive for filing plaintiff lawsuits against people. And as you can see with our experience, even when a judge concludes that there are no facts and 0 evidence, and the counsel doesn't even intend to bring any, they can still do it. The only limit is budget and shame. So if you have money and no shame, go for it. Independent thinking is rare. This sort of goes back to the Google effect a little bit, in that people don't look at the evidence, weigh it, and make their own decision so much as go with a prevailing opinion. And from our experience, what that really meant was, well, there was a $1 billion company we said was a fraud. But even though these people had been involved in, pornography, gone to prison, sued for fraud in various aspects, somehow people still think that maybe they're right and we're not. And that's the way it goes. Until, of course, you have an article in the Wall Street Journal and then you get patted on the back and they always knew you were right. And then the last thing here is that many know and many others don't want to know. And what I mean is that, when you take a company like Gerova, this company went public. It, at some point, had auditors. It had investment bankers. It had lawyers that drew up the documents. And there are elements there that they had to know. I mean, they're not blind. I'm sure they did due diligence. They knew who they were dealing with. But they don't care that much. Other people, like investors, they don't want to know. Even though the company is the one committing fraud, they view you as a party pooper and you're spoiling the party. So that's also a lesson learned. And then as we sort of draw into a close here, I mean, we think that short selling is really important work. We don't do it for nothing. And we're not just public do-gooders like Batman. There is an enlightened self-interest involved, as Jim Chano says. But some of the things we do is aid in price discovery and the proper valuation of companies and cleanse the capital markets. I mean, as these guys who were involved in Gerova, they're actually, in fact, we're extremely lucky in this case, they'll probably go to jail. And we're lucky because we received a full public vindication, whereas most people who do our work, even if they're right and the stock goes to 0, they don't get that kind of public vindication and acknowledgement by the legal system. But you cleanse the capital markets. And lastly, this is the very last slide here, that is the fruits of your labor. So what you see here, that's a Google Maps picture, and that's a close-up from a real estate site of a house, a $6 million mansion in Beverly Hills that's owned by Jason, or was the last known residence of Jason Galanison, was owned by him through an LLC. And in fact, Matthew Sulzik alleged that some of the $60 million stole from him ended up buying his house. And there's likely money from Rinion, Fund.com, two other stock frauds, perhaps Gerova that helped support that. And if it's Gerova that's involved, the largest shareholders there were CalPERS, Ohio teachers, index funds that people in this room may have owned. So there may be, your retirement savings may be 5 cents short because your 5 cents and 5 cents of a million other people went into Jason Galanis's house. And for me anyway, that creates a kind of outrage. And I think that is worth trying to rid the capital markets of it so we can all invest and see our savings grow. Thank you. And that's it. I see a question in the front row.
Me? What did it cost to defend yourself?
Oh.
Disclose that?
I'd prefer not to disclose that, but are there any lawyers in the room? A lot. You know it's not cheap, right? The lawyers are never cheap, but in cases like this, you actually have to pay to teach them. It's not as if they know everything, right? And to answer your question in a little bit of a roundabout way, it was expensive, but at the same time, our lawyers were on our side, and it could have been worse.
Second question, follow-up. Was any of it recovered?
No.
That's our system.
Yeah.
Your best result
Oh.
is paying huge legal fees.
No, we were, actually that's not quite true because in New York we were awarded $250. Which I think, as you know, is, 15 minutes of lawyer time?
No.
Something like that?
Depends.
Yeah.
So you mentioned Rule 11, and that's, were there any sanctions attached to that? Because that's basically what Rule 11 is, a sanction.
Yeah, so what had happened with that is that Matthew Sullick's lawyers said that we're going to pursue Rule 11 if this and that doesn't happen. And the other side said, well, just give us a little time to put something together. And they said, okay, we'll give you a week or 2 weeks, whatever it was. And then as that happened, they went and dismissed. And then he said, you can't dismiss. And the judge also, I guess, was on his side and said something similar. So it wasn't exactly a Rule 11 motion because it never got there, but it was in connection with the real threat of doing one and then the company trying to dismiss out of it and avoid those consequences.
Avoid the monetary sanctions.
They got there were monetary sanctions at the end of the day, or in this particular, the ruling that I showed you, obviously that was a summary. But there were sanctions involved, but I think that there were at least 2 or 3 other rulings because they kept refusing to pay. So it dragged on for quite some time. Yes?
You said you were surprised at the skepticism that your initial work received, and that you later, that you didn't understand that, and later you came to understand why that was. Is that a reference to the fact that there's a lot of manipulation by short sellers?
No, I think I don't think that there is a lot of manipulation by short sellers. I was surprised by it because I just assumed that people would want to know the truth, right? And to my mind, we published a report. It was pretty irrefutable. It was. If you read our report, it was clear that there was something going on there. That's why I was surprised. I think, in fact, there must be manipulation by short sellers. There are always bad guys. But in general, in our experience, in our sort of post-Gerova experience here, we do a lot of work with short sellers, and quite frankly, I think we're the good guys.
Well,
sellers who are willing to make claims under their own names publicly are trying to tell the truth, or believe what they're saying. But there's a lot of short selling activity undercover through others and through leaks to the press and things like that. You know, I mean, that's the reason why journalists and financial guys like your heads are really careful and skeptical, because there is in fact a lot of manipulation. But the screen that's really most effective is whether someone's going to put their name to an allegation.
Well, you know, I see what you're saying there, but now, after my experience, I really understand why people don't want to put their name on it, and it's not because I'm lying. It's because if I'm out there, and it depends on the kind of company that you're dealing with. If I come out and say Apple's a fraud, I don't think they'll care, right? Because they're not, and they have $15 billion in cash, and they sell a lot of things. But when you get to people who rely on the confidence of the market, and that may be a $100 million company or a $20 billion company, you know, they will make a stink. And I don't know, it sounds like you're aware of it, but several years ago there was a big case involving Fairfax Financial, a Canadian company, which has a substantial market cap, and they dragged on lawsuits against short sellers for years. And they were people who could defend themselves and did. And the short sellers won at the end of the day. But you don't see a lot of people writing about Fairfax anymore. So the point is that if you put your name out there and you get into trouble, the silencing works. As evidence, that was the first and last report we ever published. Okay? Is that good for the marketplace? I think not, right? So,
So what do you do now?
well, we do what we did at the time when we did that. We managed money for some family offices. So we had positions ourselves, and we had clients who had position. And now we do primarily do research for hedge funds.
Let them put
Most of them don't want to do that. There aren't very many kind of Bill Ackmans around, quite honestly.
When you say publish, obviously you put something in writing for these people, or is it all verbal?
Oh, we may put something in writing for clients, but they're not allowed to.
Something you publish and
This is something, yeah.
It was in the public realm.
It was in the public realm, yeah. So making it available to everyone is something that we no longer do.
And that would benefit you if other people followed on your footsteps.
Yeah, it would. I mean, it's like, although people don't view it exactly the same, you know, if I have a short position in a company and I tell the market why it is, and they act on, and they believe, gee, this guy's right, this is a bad company, and they sell it, I'm going to make money. That gives people a bad feeling, like it's manipulation. At the same time, turn on CNBC any day of the week, 5 times a day, you'll see guys on there talking about how company X, Y, or Z is a great buy and why you should buy it. And in reality, is there a difference? They have a position in the stock. They say it's great. The 20 million viewers of CNBC, you know, 1 million of them decide to buy it, and they buy it, and it goes up, and he makes money. It's okay for him to do it, but it's not okay for me to do it. And I mean, I understand there's some valid concerns there, because I could really, if you misuse the position of the pulpit, you can say bad things about people that aren't true. Whereas if you say good things about companies or people that aren't true, it's not harmful. So that's understood. But it's really, I mean, the difference is not slight. The difference in the way it's received by the marketplace and market participants is just vastly different.
So if I'm hearing you correctly, with the benefit of hindsight and everything that happened from you going public with your article or your findings, in the event of a fraud, and you discovered that same type of information, you wouldn't go public with that again?
I mean, probably the likelihood is pretty low, right? I wouldn't say no, but it would depend on the company, because some companies you look at some companies have very litigious histories, and you look at them and you say, if you open your mouth and say that their earnings quality is low, you know, and if you're someone like we are, which are, you know, small practitioners, we're not Fidelity or we're not UBS with a team of lawyers and billions of dollars. We're individuals making a living, right? And, you know, a reasonable living, right? But we're not a big institution. They know the quickest thing to do is just to sue us. And if they pay their lawyers $1 million, if they're a large company, that's 10 cents on their market cap. Who cares? Just sue them. It's a business decision, the way they choose to do business. So you have to be much more careful. Maybe you do something this gentleman doesn't seem to approve of, where you cultivate, relationships in the press.
Disapprove of it. I agree with you that short selling is important market regulators, like, stress testing, a lot of those things. It's just that there is abuse on both sides.
Sure.
And, it's important to recognize that abuse does occur on both sides, and that, people who are unwilling to put their names to things are less reliable. They just are. And it's not a religious position.
Yeah, no, I understand that position. At the same time, like if we talk to journalists, it would be someone that we've known and had relationships with for a long time, and it would be on their part to trust us, right? Theoretically, we could do that, but it's not as if you meet someone for 10 minutes and you say, hey, here's some information that's really going to sink these guys, and someone says, oh, great, thank you very much, and you never see them again. It's like anything else. It's a relationship exercise. Some people may be willing to do something with someone who wants to remain anonymous, whom they don't really know or trust. But most people will not.
Journalist for many years, and it's basically when you're speaking anonymously, you're laying off the risk on the journalist. So everyone has to be prepared to bear the risk. It's the willingness to bear the risk. The cost of taking a risk is you get sued. I got sued 5 times when I was a journalist of anonymous sources. I won every case, but it's the same thing. The sources were right, the stories were true, but they didn't see the source because they couldn't find them. So they sued me.
Mm-hmm.
That's why investigative journalism is dying out, just like short
So I'm
selling.
no longer investigating.
Exactly. And it's also, if I can take your point, it's a little bit about statistical odds, right? I agree that there are bad apples on both sides, but statistically speaking, there was a study done, I think Chanos did it, because the journal came up with this thing, the last bull market before this one, saying that they're short sellers manipulating stocks, and they listed 10 companies that were under attack by short sellers. 5 years later, 9 out of those 10 were bankrupt. Not decline in value, not trouble, bankrupt. So if you find me a long guy who has a 90% success ratio, you found not Warren Buffett, you found the new dimension of investing.
Steve Cohen.
He has some inside information.
Yeah, Steve Cohen is a different thing.
Yeah.
You've also done a lot of research on Gerova. Do you know the reason why it transferred its jurisdiction from the Cayman Islands to Bermuda?
No, I won't.
I don't know. This is purely a guess. It has to do with the insurance aspect and reinsurance aspect of the business. Because theoretically, it was a reinsurer, right? And so that's
It's licensed in the Cayman Islands.
yeah. Initially, but I think it also had. You're right. I don't think that they were forced to. I always assumed it was because it's a traditional reinsurer jurisdiction, and there were respectable, and that it was beneficial in some way to be there. To my mind, it wasn't a great deal different than the Cayman Islands, but from your perspective, perhaps it is.
Well, that's definitely switching jurisdictions, switching regulators shopping is frequently a sign of problems. And I think Bermuda has a reputation for being much cleaner, but I don't think that's necessarily the case.
Mm-hmm.
Well, I would say that we have very, very few insurance companies in the Cayman Islands go bankrupt. Very, very few or liquidate.
Maybe that's the point. Maybe Cayman was a little stringent.
Because Bermuda is an insurance center, it's that you have that captive phenomenon where, not insurance captive is a technical term, but clientitis, where the regulators in Bermuda cater to the insurance company because it's the biggest business on the island.
Mm-hmm. Okay. Anything else?
Since we talk about Bermuda, anything you learned about Bermuda? Because this is very US-centric.
Yeah, what did I learn about Bermuda? I don't think that we learned a tremendous amount about Bermuda. It wasn't really our focus. I mean, we had encountered offshore jurisdictions in hedge fund research. She knows more about that than I do. But I don't think that there was something, there was, because some of the assets that they owned were actually technically publicly traded companies in Bermuda. And I remember there was one in particular. And the interesting thing is, so they keep this asset on their books. It's technically publicly traded in Bermuda. But really, it only trades once a quarter on the last day at a higher price than the last quarter. So I thought, that's, so to some extent, like stock exchanges can provide services for other things other than what they may appear. And that was one thing that did come out, is that there seems to be, Bermuda seems to have that, which makes perfect sense because it has companies that generate float that need to invest it. So there are less reputable dealers there to cater to some of the less reputable investing firms.
When you do a short sale analysis, are you focusing on the offshore jurisdictions because of the less rules?
Because of the reporting requirement that's so relaxed.
I mean, we don't necessarily go out to look for foreign companies in particular. In fact, most foreign companies that trade on U.S. exchanges try really hard to mimic U.S. reporting, right? So even though maybe it's a Bermuda reinsurer, and maybe Bermuda doesn't require quarterly statements, they file them in the U.S. on time, even though they're not technically required to, because they know that legitimate investors will not want to be involved with them if they don't publish financial statements. So that's being foreign isn't necessarily a bad thing. But there are cases like Gerova exploited and other things that we've encountered where companies, even if it's an American company, it may make itself into an offshore company in trade in order to fall through these gaps. And gaps, corporate, as we saw here, there's some gaps that are reporting. There's others that are corporate governance and minority shareholder treatment and disclosure of ownership and other things. And so, but it's something that can be there, but it's not something that we always chase down. Okay. If there's nothing else, I guess that's it. Thank you for coming and your attention.